From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. The markets have been volatile since President Trump announced widespread tariffs on most countries around the world. While it doesn't feel great to go through, the markets are not unfamiliar with volatility like this. Let's first look at the benefits of investing for the long term. Since 1970, the S&P 500 has gone through 25 corrections, meaning a 10% drop from a recent peak, along with 12 bear markets and 7 outright crashes. Through all of that, the S&P 500 has averaged 10.8% total return annualized. So to understand that further, let's say you invested $10,000 in 1970. After all of those instances of volatility, your investment would have grown to over $2.8 million according to First Trust. At any given time, you should be able to ride out the volatility by maintaining enough liquidity or have enough other low volatility assets in your portfolio to ride out market downturns for about 2 to 3 years while positioning your equities for longer term growth. One way to look at the overall market is whether we're in a bear or a bull market. A bear market is generally defined as a 20% or more drop from a recent high. In contrast, a bull market is typically defined as a 20% or more increase from a previous low, accompanied by optimistic investor sentiment and signs of economic growth. If we look at the daily historical performance of the S&P 500 index through the U.S. bull and bear market since 1942, we'll see that the average bull market period lasts about 4.3 years, while the average bear market is a little over 11 months. So part of being a sound investor is understanding that bear markets are a natural part of the stock market cycle and that they can create some great opportunities. Investing in the stock market can be volatile, which may tempt some investors to pull out of the market to avoid the bad days. However, it is impossible to really predict when good and bad days are going to happen. So for example, if you had invested $10,000 in 1980 into the S&P 500 and left it alone until March of this year, it would have grown to $1.6 million. However, if you would have missed the 10 best days in that 45 years, the value would only be about $730,000, costing you over $900,000. No one has a crystal ball to predict what the market's going to do next. However, you should be proactive with your investments. That's why it's important to build your portfolio for turbulent times and not to try to adjust things too much after the fact. You should have a portfolio built with a proper amount of equities, fixed income, and some protection. This is especially important for retirees who may not have the same time horizon to bounce back from extended periods of market volatility. That's why you should work with a certified financial planner professional to help build a customized portfolio for you that helps you meet your goals while offering a layer of protection during market volatility. At Lineweaver Wealth Advisors, we have advisors who are fiduciaries and an investment committee made up of 4 chartered financial analysts to help build custom portfolios specifically for you. If you'd like us to help build a portfolio that's customized to match your goals and objectives with some protection, or if you'd like a second opinion on your portfolio, give us a call or visit us at lineweaver.net. Here's Fox News Sunday.